So, as we already agreed upon, so today we'll finish chapter 21 about, of course, the accounting for leases. So we need just to cover these appendix because we have a detailed example about, of course, the accounting for leases from the lessor perspective. So we cover that subject, and then we just need to, I don't know, to highlight quickly the a summary of the accounting for leases for both from the lessee and the lessor, and what kind of disclosure it is required also in financial statements. Okay, so this will be, of course, for the first hour. Next hour will be consecrated to the, at least, of course, we're gonna start the chapter 22. The change in accounting methods, estimates, and correction for errors. Okay, so that's really substantial or important chapter to cover for your learning as major or minor accounting. Okay. Okay. So as I said, I already shared my screen, so it's okay. You are seeing the appendix.
Yes, miss.
Yes, ma'am.
So so we just need to go in depth for this accounting for leases from the lessor perspective. So here we got the scenario of a Parker shipping here. The lessee that is leasing a standard hydraulic lift from the Stoughton trailer. That's the lessor. So the lease is signed on January 1st, specifies that Stoughton here grant right of use of the lift to the Parker. Okay, so here the lessor is giving the right of use of that asset, of the lift, of course, to the lessee. Okay. We got additional information regarding the lease term. So here the lease is said to be non-cancelable, term of 4 years. We got equal rental payment of 11,182.24 million at the beginning of each year. So this is an annuity due. So be careful, please, when it is specified it is ordinary annuity or annuity due. So that's to pay attention, of course, to the present value factor that you need to pick from the table. Okay. Here we got the left has a fair value of 40,000. Its economic life of 4 years and no residual value. The cost of this left was on the Southern books here is 30,000. There is no renewal option. The left will revert to the lessor. And we got information about the implicit rate of the lessor that is 8% and already known by the lessee. Okay. We are also provided here with the fair value of the lease, the equipment. We don't have any residual value, so we get, of course, zero. So how we measure, of course, the every year, of course, equal rental payment. Remember, so we have to divide, of course, the fair value less the present value of the residual value over what? Over the present value factor of annuity due here for 4 years at 8%. Okay, so that's the 3.57. Okay, so we got our annual payment that should be made, of course, by the lessee. Okay. So, of course, we need, first of all, to tell if this lease will be, of course, a finance lease or, of course, an operating lease. Okay, so we have to make or to proceed with this classification test. Okay, so we need, of course, to see if one of these tests, of course, will be met or not. Okay, so the first test is about the ownership test. Okay, so as it is said from the illustration, there is no transfer of ownership. So the left here will just revert to the lessor at the end of the lease. Okay, so that's the first test wasn't met. Okay, next step is to see if there is any purchase option test. Okay, if there is any bargain purchase offer or not. Okay, so here also there is no bargain purchase option in the lease. Okay, so again, the next here step or the next test wasn't verified. Following here, we're talking about the lease term. Remember, we said that the lease term, to be met, of course, that test, we should have the lease term that will be meeting at least 90% of the useful life or the economic life of the asset. Okay, so if you compare it both, we got what? The lease term is 4 years. The economic life of the asset is also 4 years. So here we got that there is a 100%, of course, the lease term is equal to 100% of the economic life of the asset. So here we got one of these tests that is already met and verified. So we can, of course, consider it as a finance lease, okay? So if we continue with the other test for the present value test, we need to, so excuse me, so we're talking about for the lease term, it should be at least 75%, but for the present value, it will be 90%, okay? So if you compare the present value with the fair value of this left, so there are actually 100%, so there are $40,000. So here we got the same, of course, 100%. So again, that's also a test that is already verified. The last here step is to see if there is an alternative use of that asset or not. So of course, it said that this left will be completely used up at the end of the lease, so it won't. How we know that it will be completely used up? Can you tell me why we just assume that it will be completely used up at the end of this lease, and of course the lessor won't have any alternative use of that left at the end of the lease? Can you guess?
Because there is no residual value.
Yes, good. So because there is no residual value, so it will be all the resources, of course, embodied in that asset will be used by the lessee, okay? So when it is, of course, a finance lease, so it's okay. So what we have to do in a finance lease, we have to recognize receivables and, of course, sales revenue, of course, transaction, okay? So that's, of course, when we talk about the lease receivable and lease liability, of course, and of course the lease liability received. So that's, of course, the amortization schedule for this lease payment. Okay, so just go back to the so again, the carrying value, of course, at the first here at the date, of course, when the lease was signed, here it was 40,000 euro. The first payment was 11 and 182. Of course, there is no interest. Be careful. Again, that's, of course, that's the first day when, of course, the lease was signed. So we don't have any accrued here interest. So that's the entire, of course, amount that will be subtracted from the lease here, liability or receivable, at the same. So 28,870, that's the new carrying value. And of course, for this new carrying value, it will be subject to what? To 8% of interest, of course. That's the 2,305. So the lease reduction here, of course, or lease liability, reduction of the lease liability or receivable will be, of course, what? The difference between 11 and 2,000. And the process will be the same until, of course, we got at the end of the 4 year here, we got 0 as a lease liability or receivable. So it's already totally amortized, okay? Of course, why we need, of course, this amortization schedule to be able to what? To recognize any lease receivable or any lease liability at the date, of course, of the contract. And then, of course, we have also to recognize if there is any, of course, receivables, interest receivable or interest payable from the lessee, of course, perspective, and also any payment of this lease annual payment that must be recorded at the beginning of each year, okay? So here we got this situation, and, you know, for both here, for the lessee and the lessor, you see how to account for that finance lease, okay? So from the lessee perspective, remember, we have to recognize an asset, the right of use an asset, and of course, at the same time, we'll have to credit a lease liability. So that's, of course, at the date of the commencement here. We don't forget that we make also the first payment, so we have to reduce the lease liability by the first payment here, and we have to credit cash. So in the other, of course, hand here, we got the lessor. So the lessor will be what? Recognizing a lease receivable for 40,000 and will be recognizing sales revenue. But don't forget that we have to adjust for the inventory. So it said that we got the cost of this left, that is 30,000. So the cost of goods sold will be debited for 30 and the inventory will be credited for 32. At the receipt of the first payment, of course, the lessor will debit cash and will credit lease receivable. Okay, so that's at January 1st, 2019. Okay, so now December 31, don't forget that we have to what? For the lessee, we got to accrue for interest expenses, but also we have to adjust for the depreciation expense because we got already the right of use of the asset. It must be depreciated over its useful life, or of course the credit term, which is lease term, I mean, which is whichever is shorter. Okay. For the lessor, we got just an adjusting entry that is related to the interest revenue. Okay. So for the lessee, we have to debit interest expense for this amount of 2,305. Of course, we will credit the lease liability, and then we have to debit for depreciation expense, so of 10,000, right of use of asset will be credited. For the lessor, we got lease receivable. Of course, here it will be increasing the lease receivable by 2,305 and recognizing an interest revenue for the same amount. Of course, there is no depreciation because already we got this is a finance lease. Of course, the asset will already taken up from the book of that lessor. Okay. So at that date, when we prepare financial statements, what we got in the statement of financial position, you know, for the lessee, you will see that we have under the non-current asset section an individual here item that is said to be the right of use assets. Okay, so that's of course it should be stated separately to emphasize the fact that it's a leased asset here. Okay. In the current liability, of course, we have to mention this next payment of the 11 and 108 the next day, of course. And for the long term liabilities, we have just to provide the remaining carrying value of the lease liability. In the income statement, don't forget we got the interest expense and we have the depreciation expense to be shown in the operating expense, of course, for the amortization expense and of course or depreciation expense, and you have the interest expense that will be in the other income and expenses section. Okay, from the lessor you will find the lease receivable, so that's just the flip side of the accounting, the flip side of the accounting for the lessor. So instead of you find the lease liability in the current liability, you'll find the current asset, the lease receivable, and of course the remaining will be non-current asset lease receivable that will be of course for more than 1 year. For the income statement, you will find the sales revenue, you'll have the cost of goods sold, and you have your interest revenue to be accounted for in the first section. Okay. For the second payment, so there is no special treatment. You have to debit the lease liability for the entire 11 and 182. You have to credit cash for the lessor. So here it should debit cash and credit lease receivables. Again, the same process will be repeated. So for recognizing here interest expense and depreciation expense, and also for recognizing any interest revenue. Okay. So again, that's the same maybe presentation, but of course the difference will be regarding the interest revenue, for example, the non-current asset lease receivable and also lease liability that is of course reduced. Interest expense also is different. The depreciation expense is the same. The right of the use asset, of course, that's the book value. That is no longer 40,000, it is 20,000, etc. Okay. The third payment, again, so there is no specific accounting treatment as we used. We debit the liability or credit cash for the lessee, and of course we debit cash and credit lease receivable from the lessor. At the end of the year, we had to accrue for interest expense or interest revenue. We don't forget that we have a depreciation expense to be recognized from the lessee, for the lessee. And then, of course, all of these, of course, items, of course, will be shown in the statement of financial position and in the income statement in their respective, of course, sections. For the fourth lease payment here, that's the last year, we have, of course, lease liability, of course, of 11. We got cash to be credited, and again, cash to be debited and lease receivable to be credited. Okay, so here there is no, you see, there is no special treatment for the residual value because it's said to be 0. Okay. Already there is, of course, no additional here interest expense or depreciation expense or the opposite interest revenue because it's already the last payment, though, so there is no another year, let's say, to accrue for interest or to recognize any depreciation expense. Okay, so that's the first situation when you got this finance lease, of course, as it is classified by both, by the lessee and the lessor. So please remember, for the lessee, it is, let's say, systematically a finance lease as long as it is not a short-term lease, so meaning short than 1 year. And of course, if it is not of low value, of course, low or so it will be less than or equal, of course, of $5,000. So all the other leases that are actually above the 5,000 or more than 1 year, they are, of course, to be systematically considered as lease, finance lease. Okay, so we can say that for the lessee, so for most of cases, they have to consider all the leases that they signed for, of course, as a finance lease. Okay. What is, of course, different is for the lessor, because for the lessor we have more conditions to follow in order to what? To classify this lease as a finance. If, of course, the 5 steps, of course, of test, they were not met, no one, of course, was met, in addition to the fact that the lease should be non-cancelable, and of course, that's, of course, the situation where we are, of course, allowed to recognize it as what? As an operating lease. And for that reason, we have to what? To account for every lease payment, of course, as so that's how the revenue will be, of course, recognized on installment, so over years. And of course, there is no the asset will belong, of course, to the lessor. Okay, we'll see with this example. Okay. So again, if we got, of course, the same situation, so the lease is non-cancelable, term of 4 years, equal rental payment, but here we have a different rental payment that is 9,538,000 or 9,000, excuse me, 538 at the beginning of each year. The lift has a fair value still of 40,000. The economic life is still now it was 4, but now for this scenario, second scenario, it is 6 years. We got here also a residual value that is unguaranteed. Okay. The cost of the lift here is still 30,000. There is no renewal option. The lift will revert to the lessor, and we also got the same implicit rate, of course, that is of 8%. Okay. So here we got to know how to measure, or how this 9,538,000 was measured. So remember, from the lessor, so this amount is always computed and fixed by the lessor. And how to compute it for the lessor? He must actually take off first the present value of the residual value, whether it was guaranteed or unguaranteed, and then we have, of course, to measure, of course, the first beginning, of course, of yearly payment to earn an 8% return. It will be 35, of course, multiply or divided by 3.7. That's the present value factor of annuity due. So we got our annual payment of 9,538. Okay. So the next step is to tell or try to evaluate or classify the lease if it is a finance or operating lease. Okay, so let's see together. For the transfer of ownership, already said that there is no transfer. The asset will revert to the lessor at the end of the lease. There is also no purchase, bargain, or bargain purchase option already offered. Nothing offered. For the lease term, here we got what? The lease term is 4 years, while the economic life of the asset is 6 years. Okay, so if you just measure this ratio, you'll see that it is not covering actually the 75% of the life of the asset. So still also this test is no longer valid. Okay, so the following test is about the present value test. So if we compare the lease payment with the so this is the lease payment, of course, the 4 years and lease payment. If you compare it with the present or the fair value of that lift, so it is barely 85%. So it's not meeting the 90% here threshold. Okay, so again, this present value test is not met. For the alternative use test, of course, so it said that the lift, there is no specific nature of that lift. It is not, let's say, tailored for the need of the lessee. Okay, so here it will be used maybe alternatively by the lessor when it is returned at the end of the lease term. It can be, I don't know, leased again or sold, etc. But it's possible that the lessor will make an additional use of that lift, of course, at the end of the lease term. So also the alternative use test here is not met. Okay, so if we got the 5 steps, no one of these 5 tests, of course, is met. So what we do is that we have to consider the lease as an operating lease. Okay, and when it is an operating lease, of course, that's from the lessor perspective. But for the lessee perspective, you see that we'll have to continue recognizing the asset, the right of use of asset, and of course crediting the lease liability for this 34 and 119. Okay, that's also the first payment. So there is nothing different, of course, in exception the different amount, because here we are considering an unguaranteed residual value of 80,000, I guess, as it is provided. So here for this amortization schedule for the lessee, so as we used to do, so remember we have, of course, for the first payment, there is no interest expense to be accrued for. For that reason, that's the entire reduction of the lease liability to be considered. That's only for the first year. Then, of course, we have to to allocate the reduction or this annual payment between between reduction in the lease liability and the interest, of course, expense that we measure again by multiplying the 8% with the carrying value of that lease liability. Okay. And for, of course, still doing with the lessee, so we got to recognize an interest expense at December 31. We have also to recognize the depreciation expense for over, of course. So that's a straight line method. So we have to, for every year, we have to recognize that portion of 8,529. Okay. So the same presentation, the statement of financial position for the non-current asset, non-current asset, that's of course for the right of the use, but for current liability and non-current liability, so that's about the next payment of the lease liability and the what is left for the other 3 years. We got the interest expense and depreciation expense, so that's the same as we already learned. The second payment, then of course we have the accruance of depreciation and interest, again the same presentation. The third payment, the accruance, of course, of interest and depreciation expense, the same presentation again. So just be careful regarding the amount that will be debited or credited. But for the 4-year, so we got to recognize the 4-year payment and of course the last depreciation expense to be recorded. Okay. It is unguaranteed. So you see here, because it is an unguaranteed residual value, so nothing to be, of course, done by the lessee. Okay, so no accounting treatment for the lessee. Okay, let's see now for the lessor and how this operating lease will be accounted for. Okay, so again, none of the sales type lease criteria are met. Okay, so here we are, of course, in the situation of recognizing that lease as an operating lease. Okay, and remember, when we said that as an operating lease, we got to recognize revenues on installment, so every year. So for that reason, the first year payment that we collected as cash, it will be recognized as what? As an earned revenue. You see here, why unearned? Still, we didn't earn, of course, that's the first payment, but it will be recognized as revenue at the end of the accounting period. Okay, so that will be done for the entire 4 years. Every year on January 1st, when we receive the lease payment, we'll debit cash and we credit the unearned lease revenue. Then at December 31 of each year here of 2019, 2020, 21, and 22, we got to convert our unearned lease revenue to lease revenue, but also we have to depreciate our asset, because as we said, the asset will be remaining within the books of that firm. So we have to debit depreciation expense and we have to credit accumulated depreciation for the 6,666. Okay, you see here we have just continue, as I said, depreciating the expense of the asset over its useful life. Okay, so that's all for the lessor. Okay, that's also, again, there is nothing to also to proceed with regarding the guaranteed residual value, because nothing was guaranteed. So let's just simplify the example, because when it is guaranteed, remember, we have to get it back and account for it. Okay, is that clear, please? Is it?
Yes, clear, ma'am.
You. Okay, so just one thing before we leave that chapter, we have just to talk a little bit about, yes, the disclosure here. For the other lead adjustment, we just need to omit, so we don't have really enough time to talk about it. You already know about this presentation, so about disclosure, yes. So I don't know if my screen is still shared.
No, it's not.
No, no.
And okay, so okay, so again, for this presentation, disclosure and analysis here, this is the last slides that we'll cover for that chapter. So remember, for presentation, nothing new. Already learned the fact that we have to recognize or to show this item in the liability, current liability, long-term liabilities, of course, right of use of asset under the non-current asset, depreciation expense, and of course, interest expense in the income statement. That's for the lessee. For the lessor, of course, it depends if it is a finance or an operating lease. So that's already discussed. Okay. So, of course, in addition to these items that will be provided in the financial statements, businesses will have also to provide the additional disclosure. That's not really considered to be enough information regarding, of course, their leased equipment. Okay. So the lessee and the lessor both must provide what? Additional qualitative and quantitative disclosure to help, of course, the financial statement users assess the amount, timing, and uncertainty of future cash flow. So that's, of course, the general, let's say, objective of providing, of course, financial reports. Okay, so the objective of financial information is to help users be able to assess the amount, timing, and uncertainty of future cash flows. Okay, and because, of course, the lease payment or the lease, of course, receivable, that's an important actually future cash flow. So we need, of course, additional qualitative and even quantitative information to provide, of course, details about this kind of contract. Okay, so both the lessees and the lessors are actually entitled to that requirement. Okay, so they need they must, of course, provide this additional information. So example of this additional information and this qualitative, let's say, lease disclosure can be, you have to describe the nature of the leases, if they are finance, if they are operating lease, if they are short-term or long-term, for example, for the lessee. So you have a general description of these leases. If there is any variable payment, how they are determined. If there is any terms and condition for option to extend or terminate the lease, and for the residual value guarantee. So if there is any, for example, bargain renewal option or a bargain purchase option, that should be, of course, indicated here in this additional disclosure. If you got also any information about any assumptions or judgment. So here we're talking about, in particular, the discount rates, okay? Because, we said that the discount rate must be, first of all, the implicit rate or the incremental rate that we must, of course, use if we are not aware about the implicit rate used by the lessor, okay? So if we are just engaged in, I don't know, specific computation or judgment estimates, of course, of these discount rates, it must be, of course, highlighted all the steps, of course, and the reason why we use that process. Okay. Also, in addition to this qualitative information, we have to provide quantitative information regarding the lease, of course, agreement. So for the lessee, it must, of course, as a firm, it must provide what? The total lease cost, how much, of course, it costed. So if it is a finance lease cost, and of course, it will segregate between what? The depreciation of the right of the use asset and the interest on the lease liability. So of course, we must not, of course, what? Provide aggregated information regarding the depreciation of that right of use asset and also the interest that we are paying over that lease liability. As we already learned, we have to provide this information separate, okay? Again, if there is any low value of short-term lease cost, it must be, of course, talked about. Here, when we have an weighted average remaining lease term and weighted average discount rate, if they are, of course, using, of course, I don't know, many leases, of course. So they are, for example, using this weighted average or weighted average discount rate, etc. If there is, or if it is possible, any maturity analysis of finance lease liabilities on annual basis for a minimum of each of the next 5 years, the sum of undiscounted cash flows for all years thereafter. So you see here, we got to provide more information about the maturity of these finance leases on annual basis, how much, of course, we will have to collect and how much, to pay for the lessee. And of course, the sum of all undiscounted, of course, cash flows that we are actually entitled to over the lease term, okay? For the lessor, so that's, of course, another type of information like lease related income, profit and loss, for here when we're talking about the sales types, and direct financing lease, etc. If you have, of course, any variable payment, if you have any carrying value, of course, of the lease receivable, any unguaranteed residual asset, value, of course, of the asset, any, of course, operating lease. So here, a maturity analysis of that operating lease. If it is, of course, you are making, I don't know, you have risk management here. So your approaches for risk associated with this residual value of leased asset. So we already ignore this buyback agreement or third-party insurance. So it's really a lot to cover for that chapter. But of course, it's also important for the lessor to highlight the fact how they are. They will be actually dealing with the leased equipment once, for example, it was reverted back to them. And in particular, when they got, for example, the situation of unguaranteed residual value and all of this stuff, okay? Guess so that's all the kind of disclosures that must be, of course, provided in their annual reports or in the notes disclosure, but they are actually an integral part of the information that must be provided regarding the lease transactions, okay? So here we just need to just give small, let's say, of course, analysis on how this new standard is actually impacting the financial statement of both, okay, of the lessee and the lessor. And you see that in particular for the lessee, because as I said, what is new from that standard is that basically all the leases, they must be considered as a finance lease, of course, with this exception of the short-term low value, okay? So again, as a lessee, I will see that I have what will be higher amount in asset and higher also liabilities, okay? So here the number, of course, of financial, of course, metrics or ratio that were used to measure the profitability or solvency of companies will change, okay? So again, for the lessee, we got what? Right of use asset. We have a lease liability that is recognized, of course, under the current and non-current liability. So our return, of course, on asset will decrease because we see that we have higher assets. So our return on asset will decrease, okay? Also, the earning before interest, taxes, and depreciation and amortization here will have to be, of course, adjusted for what? For this depreciated right of use asset and for this recognition of interest expense, okay? So also the debt to equity ratio will increase, okay? So remember, we have higher debt now, and of course, debt to equity ratio will increase, and also the interest coverage here will decrease because we'll have higher amount of interest expense to pay, okay? So these are, as I said, one of many reasons, of course, that explain, as I said, the lobbying against this standard, in particular, of course, from the lessee perspective, because they used actually to what? Most of businesses, they used to recognize or not recognize, but provide this information as off balance sheet. Okay, so they don't recognize any asset, neither of course a liability, and they were actually comfortable with, let's say, providing a high return on asset or lower debt to equity ratio. Now, if it is of course of higher debt to equity ratio, so they are riskier. They have maybe more problems in funding their new project, so they have to pay for higher rate of return because of their credit position, of course, that is riskier now with this new standard. Okay, but again, when a standard is developed, that's of course with the objective of what? Of providing relevant, faithful representation of the reality, and of course to serve in particular the informational needs of investors and the creditors. Okay, so this is not about serving the interests of preparer of financial information or other categories. Okay, is that clear, please? For the sales leasebacks, that's really a little bit complicated here scenario. So if you want just to I don't know, to widen your culture or your knowledge regarding the leases transactions, you may read it for your own information. Okay, so it is not part of our courses. Okay, is that clear, please?
I still didn't remember.
Yes.
Didn't know what is the use of this leaseback. So, what is the profit from the lease?
For the leaseback here transaction?
Yes.
So this is actually a situation when you have, I don't know, the lessor want actually to lower the risk about, of course, its residual value. So will be, of course, this scenario complicated that you have to sell, of course, an asset, of course, to another company, and then, of course, you lease back that asset from the buyer. Okay, so you will be at the same time the seller, but the lessee. Okay. So you sell an asset, and then you, of course, you will be leasing back this asset from the buyer. Okay. We don't really have enough time to discuss all of this stuff. Please, if you adjust, I don't know, it is not really covered, as I said, by this program. Unfortunately, I use it to cover, but for you, I cannot. It's not really big deal. You can just read it. Try, of course, to just learn something maybe new from these specific situations, but as I said, it's not a big deal. What is important for us, we already covered that. So the accounting for the leases from the lessor as an operating lease or as a finance lease, when we had this guaranteed or unguaranteed residual value, how to measure, of course, the annual payment, the interest, and of course, as I said, for the operating, when we have to recognize revenues on installments, so only at the end of every accounting period, and all of this, of course, basic accounting treatment. Okay, so these specific situations or transactions we may learn after, not of course important at this level. Okay. I don't know, Zakaria, if you want to read it, of course, you can just go back for me with an email. Of course, if you have some inquiries or questions, I will be happy to answer. But let's stay, today we got 1 hour and let's say 15 minutes to start and tackle an important part of the chapter 22. Okay, because don't forget, chapter 22 is really long. We have to finish it, and eventually, if we got any possibility for an extra session, we may cover chapter 19, income taxes. If it is not possible, then so I did my best, of course, to cover the entire syllabus.
Sure. I will see it in. If there is something that I didn't understand, I will email you. Thank you so much.
Okay, Zakaria, thank you. Okay, so chapter 22 here. For chapter 22, that's really, as I said, an important chapter for you as a future accounting or as a financial analyst, or I don't know, as a part of the accounting or finance department in one business, or even as I don't know, accounting researcher or academicians or whatever. So it's important. That's one of the important chapters to cover and to know about it. Okay. So what we got now, we will be talking in chapter, already shared the screen, I don't know, I just need to, okay, I'll share it again.
Yes, it's shared.
Okay, good. So for chapter 22, it's about the accounting changes and error analysis, okay? So in particular, we'll be discussing the different types of accounting changes. And of course, if these changes are occurring, how to account for that, okay? So here, if we make, for example, any changes in accounting policies, how to account for it. If we are making any changes in estimates, how we account for it, and why we provided that, of course, separate, let's say, learning objective or separate sections, because you'll see that the accounting treatment will differ based on the fact if it is an accounting policy, change in accounting policy, or change in accounting estimates, okay? And then we got to also to consider separately any correction of errors, okay? And we continue, of course, with the errors because it is really important. We have to know how to analyze the effect of errors and how, in particular, to correct for these errors, because it is a little bit complicated. It depends on different situations, different scenarios, okay? So let's start first by the accounting changes, okay? And of course, we'll talk about the change in accounting policy, as I said, and change in accounting estimates, okay? So remember from the beginning when we started talking about the concept of framework for financial reporting, and when we also tackle, I don't know, different accounting principles, etc., you may notice that we got, the FRS is actually offer many alternatives on, let's say, accounting or valuating assets, liabilities, etc. Okay, so we got many alternatives, and you may, for example, think about, I don't know, valuation of cost of goods sold and ending inventories, for example, at what? At FIFO, or at average cost, or at specific identification. You may also think about, for example, depreciation expense, how it is measured. Measured, of course, based on straight line method or declining balance method. What else? You may also think about, I don't know, change by using the historical cost to the fair value measurement, etc. Okay, so we have many alternatives, and that's, of course, one of, let's say, merit of IFRS is that it is more principle based. So you are provided with the broad concepts and the principles, and you are left actually with, let's say, important discretion and freedom to choose or to pick the more, let's say, relevant and faithful representation, of course, of your reality when, of course, you are just deciding to pick which method, for example, will be used. You may also think about using, for example, the percentage of completion method or the cost recovery method, for example, when you have this long-term contract, etc. So it's not the only ones, okay? So if you go just back to the conceptual framework for financial reporting, you may also learn about replacement costs, about, of course, in addition to the historical costs, you got replacement costs, you got, for example, the fair value costs, you have the all the other, or exit costs, etc. So you have really many alternatives, okay? And of course, that's, as I said, that's the merit, and that's also one of maybe, let's say, not cons, but maybe some of the critics that are made, of course, to IFRS, is because when you are offering actually different or many possibilities to businesses, to the preparer of financial statements, it may what? Diminish the comparability of financial information. So as, of course, as a reader of financial information, whether for one firm or for many firms, I can just not being able to compare the financial information provided. Why? Because these firms, even though they are, of course, belonging to the same sector and may, of course, having the same maybe activity, etc., they are what? they are providing financial information, for example, regarding, I don't know, their inventories, regarding, as I said, their depreciation, regarding the cost that they are using to value their asset, etc. In different ways, in different, of course, methods or policies, or even their estimates. Okay, so we'll be talking about that. So this, of course, changes, or these actually alternatives, as I said, will not help the comparability issue. So we don't have comparable financial information or consistent financial information over time. So again, as I said, it will obscure what? The useful historical trend data. So that's about, of course, the consistency. When you are, for example, providing, I don't know, your inventories based on the FIFO, then you will change to the average cost. Or when you are, I don't know, accounting for revenues on percentage of completion, then you switch to the cost recovery. So you are actually what? You don't providing that useful historical data consistent, of course, over time. Okay, and of course, again, that's will lower actually the comparability of that financial information, etc. Okay, so despite, of course, this maybe, as I said, disadvantages of all of these alternatives that are offered by FRSs, they are actually allowed. Okay, so that's, of course, flexibility. You are allowed, but of course under certain conditions. So for that reason, of course, IFRSs require specific accounting treatment when, of course, you decide to make this kind of changes. Okay, so before talking about the different, of course, accounting steps or processes that are needed, of course, you need, first of all, to learn about the different types of accounting changes. Okay, so keep in mind that we got, in particular, two types of changes. We have a change in accounting policy and change in accounting estimates. Okay, so we'll define each one and see what will be the specific accounting treatment for every situation, if, of course, it is already used or done by businesses. Okay, errors that are not actually an accounting change. That's, of course, when you make, I don't know, an error or a mistake that was, of course, in good faith. So that's where we talk about errors. And you may just ask the question why, for example, we are just covering errors in the same chapter, because you will see that the accounting treatment for errors will actually, to some extent, will be similar to change in accounting policy. Okay, to the accounting, of course, of the change in accounting policy, but still is not an accounting change. You are correcting for an error, for a mistake that was, of course, done in a specific period of time or a specific accounting year, and then, of course, you will have to correct for it once you discover that error. Okay, so before talking about these errors, etc., we'll have to, let's say, define in a concise way what is a change in accounting policy. Okay, so please, again, that's really important. A change in accounting policy must be from one accounting policy that is accepted to another one also accepted. So meaning, you, for example, when you switch from average cost, for example, to LIFO, that's of course, LIFO is not really accepted under IFRS, but it is, for example, accepted under the US GAAP. Okay, so when you change from one accepted accounting policy to another one that is also accepted, that's what we call a change in accounting policy. When, for example, you change from a cost recovery to percentage of completion method. Okay, that's also another example of a change in accounting policy. So what you have to keep in mind that if you, I don't know, adopt a new policy, for example, to recognize what? Event that had occurred for the first time and that they were previously immaterial, that's not an accounting change. For example, simply put, when you start, for example, accounting for research and development costs as research and development, of course, expenses. Okay, you are expensing them, and then, of course, because you have, of course, that economic viability that was proven, and you got that some criteria for capitalizing that is that are met, then, of course, you will, for example, account for them as assets. Okay, so if you were expensing, and now because of specific situation and new conditions that you are able to capitalize, that's not meant to be a change in accounting policy, okay? So what we talk about it is that it is not adoption of a new policy of recognition that is, of course, done because you are recognizing now new events or new situation that occurred for the first time, okay? And of course, previously they were immaterial or not, of course, existent. That's not an accounting change. So what we talk about it when we talk about the change in accounting policy, that's changing, as I said, from, for example, accounting method for, as I said, for inventories, accounting method for revenues, of course, in long-term contracts. We can see, of course, other types, of course, when you have to make this change in accounting policies, okay? So you may just, for example, have or think about how to account for the situation. So if there is any change, we may just report that change. Of course, the accounting, let's say, consequence for that change is that we have to what? To use the or just to account for that change in the current period. Meaning, of course, if that change occurred in 2022, as a firm, I decided to change from the average method to the FIFO method. So now, in the financial statement of the current period of 2022, I will have to show my inventories no longer at the average cost, but at FIFO. That's, of course, the current approach. Or you may use the retrospective approach, okay? When we say retrospective, meaning that we'll discover that together, you will have actually to go back to the prior periods financial statement and make a specific adjustment to show the financial reports with the new standard applied as it was applied from prior since the prior periods, I mean, okay? Or the prospective, meaning you just need to apply these accounting changes in the current period, but also in the future, as long as you actually continue, of course, holding or accounting for this kind of asset or revenues or whatever, okay? So for the change in accounting policies, the requirement based, of course, on IFRS is straightforward, okay? It's clear cut. We need to use the retrospective approach, okay? So you don't have actually choice, okay? You are obliged, that's a requirement when you have making any changes in your accounting policies, in your accounting methods, you must use the retrospective approach. What is the rationale? Here is that that's mostly because of the comparability issue, okay? So users can then better, of course, compare results from one period to the next. So the income statement, for example, won't be, I don't know, different, or the net income. Why? Because we changed the how we measure it, the cost of goods sold, as I said, for example, based on the average method or the FIFO method. Now, if we change it to the FIFO method, even the prior year's financial statement will be restated or readjusted based on this new change in the accounting policies, okay? So we'll see with an example, of course, and we'll see the different steps that we need to undertake in order to apply this retrospective accounting change approach, okay? So this will be highlighted, of course, in two or three steps, okay? So first thing is that we need, when we talk about retrospective approach, meaning the company will reporting this change by what? By adjusting its financial statement for each prior period presented to the same basis as the new accounting policy. So each time or every year we are, I don't know if you are, you may know all that when we prepare financial statements and we provide this financial reports, we don't find only a column for the current period. We provide, for example, 1, 2, 3 years, of course, as a comparability columns in each time, of course, we prepare financial statements, okay? So every time or each period, prior period that is presented, of course, in this financial statement, it must be provided or readjusted based on the same new basis for accounting policy, okay? So if we say that they must be, of course, presented in the same basis, so meaning what? We have to take a look at the carrying amount of the assets and liabilities as of the beginning of the first year presented. Okay, so here we will need to adjust the amount of the asset and liabilities at the beginning of, as I said, of the first year presented. And of course, you may think that that's of course obvious. This change in amount of assets and the liabilities will be also what impacting the opening balance of the retained earning. Okay. Also, so you'll see that we have other components of assets, equity, etc. That will be, as I said, impacted by this retrospective change. Okay. So we'll see with an example, you will better understand, of course, the retrospective approach. Okay. Let's take this quickly, the illustration here. The Denson here SA that has accounted for its income from long-term construction contract using the cost recovery, zero profit method. That was, of course, in the early situation. Now in 2019, the company changed it to the percentage of completion method. And managers, they are what? Believing this approach provides a more appropriate measure of the income earned. Okay. So again, please, that's also important. We'll discover that together. But you may know that when we change in one of the, of course, accounting policies, in addition to the accounting treatment that we will discover together, they have also to make additional disclosure to motivate their choice, to tell the reasons why they change it, and of course, all the valuable arguments in favor, of course, of the new policy, etc., that should be described. Okay. For tax purposes here, it said that the company uses the cost recovery method and plans to continue doing so in the future. So here we're talking about 40% enacted tax rates. Okay, so the business uses it to what? To refer to the cost recovery method in accounting for its revenues, of course, from long-term construction. Okay. Now they decided to change for financial reporting purposes to the percentage of completion method, but they kept, of course, the cost recovery for tax reports. Okay, so that's not a big issue here. So we have actually to be able to proceed with this retrospective approach. We need to contrast the effect of the change from the cost recovery to the percentage of completion to the what? To the accounting, of course, items, whether asset, liability, or incomes, etc. Okay. So here, of course, because here we're talking about accounting for revenues, etc. So it's more likely that we'll be talking about the income statement. Okay. So that's a partial income statement here now for the year ended December 31, 2019. So for the firm that is, if they are kept using the cost recovery method, they got in 2017 the income before taxes, that is 400, 2018 160, and then 2019 190. They pay income taxes of 40%, so income tax expense of 160, excuse me, and 64 in the following year, and 76 in the next year. So the net income was the following: 240, 96, and 140. Now, if you just take a look at this table, or this income statement as presented, but of course based on the new method, the percentage of completion method. Okay, so you see here the income before income taxes, of course, will be higher because now we are recognizing what? Gross profit of every period. Okay, so it is 600, then 180, then 200. And of course, the income taxes, of course, will follow. That will be higher, 240, 72, and 80. And then, of course, we have a higher net income of 360, 108, and 120. Okay, so these are the two income statement, of course, partial ones. Of course, if we are using the cost recovery and then the percentage of completion. So what we need to account for is that, first of all, we need to account for the effect of that changes as an adjustment, of course, to the retained earnings account. Okay, so how to proceed? And that's, of course, the retrospective approach. Okay, so first of all, we are making actually the change in 2019. Okay, so the beginning 2019 retained earnings, of course, must be adjusted. Okay, so prior to 2018, that's of course the 2017, the pre-tax income that is using the percentage of completion was 600, okay? The cost recovery was 400. So the difference is 200. So if we apply the 40% of tax effect here, so the net actually increase in my income, it is 120, okay? Because of that switch from the cost recovery to the percentage of completion. In 2018, I got what? I got a difference of 20, but the net effect or increase in my income was of 12,000, okay? So in the beginning, that's of course the current period. So we got what? The percentage of completion, 780. If we are using the cost of recovery, we had the difference of 220. So we got here, so that's of course, as I said, that's the beginning, meaning before, of course, we switch. So that's at the beginning of 2019, the year where we decided, of course, to make the change, okay? So this is, of course, here showing or illustrating the effect of if we were using the percentage of completion method in prior periods, prior, of course, to 2019, meaning in 2018 and 2017, okay? So we had a difference of 220, but the net, of course, increase in my income will be of 132, okay? So as I said, in 2019, here we got, of course, a difference of 6,000. That's for 2019, okay? So please, the first step is that we need to highlight the differences regarding the asset, well, income, of course, or liability items, of course, that are impacted by that accounting change. And we need what? To account for or to adjust for any year presented. So now we are tackling 2017, 2018, because they are the 2 years that are presented in the financial statement of that firm. So the firm, they managed to what? To provide the current year financial statement in addition to 2 prior years, okay? So the 2 prior years that we are presenting, actually, they should be adjusted to the percentage of completion method, and also the effect of that change will be shown in the retained earnings in the beginning balance. So you see here we got what? We got an increase of 132 that we will see how to account for it. So remember when we got this 220, that's the total gross profit that wasn't actually, or all the gross profit that were not recognized in 2017 and 2018 because of use of the cost recovery method. And remember, if we were using the percentage of completion, we would have what? Debited the construction in process for the gross profit, okay? So this is what we will do now, okay? So the construction in process, this asset account will be debited by 220, and we will be crediting a deferred tax liability. Unfortunately, we'll have known what is deferred tax liability if we just covered the chapter 19, but it's not really a big problem. Just explain it. You know, when we're using the cost recovery, you were recognizing lower revenue, so you were paying lower taxes, okay? Now, if we will be applying the percentage of completion method for the prior, of course, periods, we got to what? Any tax liability that I have to pay in the future, okay? So that's what we call deferred tax liability, okay? So it will be, of course, credited with the entire, of course, tax effect here of 88. And of course, the difference, this 132, that's, as I said, retained earnings that will be credited with this net effect on income, okay? So that's how we apply the retrospective approach. So, of course, in addition to the change to line by line in the financial statement to the items that are impacted by that change, okay? So first thing is that we make a journal entry at the beginning of 2019. You see here, the beginning of 2019. We didn't even talk about the end of 2019, but now at the beginning of 2019, we have to account for that change from the percentage of completion to the from the cost recovery to the percentage of completion, because we are obliged to use the retrospective approach, meaning we have to adjust for prior periods and of course show the prior period as if they were what? using the percentage of completion method. Okay, so that's of course if they were using the percentage of completion method, the firm would have recorded a higher construction process, an increase by 220. The firm would have paid more tax expense of 88, and of course the retained earnings, because you know these are accounting period that were already closed. Okay, that's why of course we'll have to credit retained earnings for that effect on net income. Is that clear, please? Is that okay?
Yes, ma'am.
Okay, good. So in addition, of course, to that accounting, of course, as I said, journal entries, of course, are accounting treatment. So we need also to provide major disclosure. Okay, so again, that's, you know, IFRSs, or of course the accounting, of course, standards, they don't expect to find, of course, this change in accounting policy to be recurrent, to be, of course, I don't know, often. Okay, so it's likely to be like exceptional, okay, situations. Okay, so if it is happening, if it is, of course, decided by businesses, then they have, in addition, of course, to that retrospective accounting treatment, of course, an adjustment to the retained earnings, to also to the other accounting impacted by that change. So there are also additional disclosure that must be made. Okay, like what? Providing information about the nature of the change in accounting principle, change from, as I said, from the percentage of completion to the cost recovery, or the opposite, change from the average cost to the FIFO, or the opposite, etc. So we need to state explicitly what was the change. Okay, what was the prior accounting principle, and then now the new one. Okay, and also, most importantly, the reasons why you think that applying the new accounting policy will provide reliable and more relevant information. So you simply have to motivate your choice of changing from this old accounting policy to the new one. So you have to provide strong reasons, because when you, I don't know, just pick the cost recovery, you may, of course, or you must have already thought that it was reliable and the best maybe method that will be providing the relevant and useful information to the users of financial information. But now, if you decided to change to the percentage of completion, what made you change your mind, if you may say so? Okay, what are the reasons that you drive you, of course, to switch from the average cost to the FIFO? We may just, for example, I don't know, had new types of inventories that you think, of course, it is more appropriate to use the FIFO instead of the average cost, etc. And then, of course, for the current period in this example, for example, 2019, and each prior period presented, for example, 2017, 2018 in the prior example, to the extent practicable. Okay, so that's also the practicability issue is important. I mean, what if it is possible for you to provide, of course, or to present information about prior periods for 2 or 3 years, or only one period, of course, the amount of the adjustment should be what? For each financial statement line item affected. Again, every item in financial statement that was affected by that change, and for all the prior periods presented, to the extent, as I said, practicable, because you may sometimes not being able to provide that information for, I don't know, more than 2 years, or etc. Also, the basic and diluted earnings per share, because you know that for the income statement we provide the earning per share at the end, of course, if it is basic or diluted, etc. And then, of course, the effect, of course, of that change will be shown on that earning per share. The amount of the adjustment related to the prior periods, of course, before those presented, to the extent practicable. So again, even though we can go back to what? To prior periods before those you are presenting, and before, for example, 2017, 2008. So if it is possible, if it is practicable, you may even provide, I don't know, 5 years of financial reports showing, of course, the use of this new accounting policy. For what? For the sake, of course, of comparability, for the sake of presenting relevant information to investors. So now investors, they were not being, I don't know, being biased or misled, because I cannot really compare, as I said, cost of goods sold. If I were using the average cost and then the FIFO, or if I will be comparing between different businesses for over years, etc. Okay, so this is just an example on that dental firm that decided to switch from the cost recovery to the percentage of completion method. So we just need to read it even quickly to know how to present this kind of disclosure. Okay, so you see here the company has accounted for revenue and cost for long-term construction contract by the percentage of completion method in 2019. So that's of course the new accounting policy. Whereas in all prior years, revenues and costs were determined by the cost recovery method. Okay, so that was of course you may think tell when of course it was used of course for starting for example in 2015, 16, etc. The new method of accounting for long-term contract was adapted to recognize, you see here, you have to state the justification and motivation for your change in accounting policies. And you may also tell that you already applied the retrospective approach. So you are saying here that the financial statement of the prior years has been restated. So we adjusted here to apply the new method retrospectively. So you are saying explicitly that you are using the retrospective approach. You are saying here also that for tax purposes, you continued using the cost recovery method, okay? And you are also telling about the effect of that accounting change on 2019 income. That was an increase of 6,000 net of taxes. And of course, the prior period, of course, impact on retained earnings was adjusted, of course. So as a result of that accounting changes, you got that information of the retained earnings as of beginning January 1st, 2019 was increased by 120 compared, of course, to what was reported using the cost recovery method. Okay, so that's an example in the notes disclosure. The note A here, the change in accounting method for long-term contract. That's an important, of course, note where you have to, as I said, motivate. You have to first describe the change, provide the reasons why you change it, and then provide details about the effect of these changes, not only on the current period, but also on the prior period, because you are, as I said, required to use the retrospective approach. Okay. So we'll see this effect on the retained earnings, of course, statement. Okay. So again, we have to what? To go back and adjust the retained earnings statement, okay? Because we have to provide, of course, this effect and this adjustment to the prior period. And why for the retained earnings in particular? Because, you know, the retained earnings, as we said, that's a cumulative information that will be provided from or accumulated or carried on from one period to another. So that's important that you will show that effect in the beginning balance of the retained earnings, so that your retained earnings at the end of the year will be with the correct balance. Okay, so before the changes, you may just here see in 2017 we got what? The beginning balance of the retained earnings that was 1,360,000. We had the net income of 240 based on the cost recovery method. So we got the retained earnings ending balance of 1,600,000. So this, of course, will be the beginning balance of 2018. We'll just not need to add our net income from the cost recovery method here. And we got, of course, the ending retained earnings in 2018. In 2019, that's of course where the problem will be. Of course, we need to be careful about, because so that's about the old method. So we have a retained earning balance beginning January 1st of 1,696,000. Continue using the cost recovery. So we got a net income of 114, and then we have a retained earnings of 1,810,000. Now, if we before actually 2018, so that's of course in 2017. So if we are using the percentage of completion method, we would have our retained earnings that is of 1,720,000, not 1,600,000, okay? Because here we got this additional 120 that is of course related to the 2017 ending balance of retained earnings, okay? So that's of course the cumulative effect difference, okay? So please, to be able actually to provide the beginning balance that is correct for 2019, we have to make or to proceed with the adjustment, okay? So the retained earnings as of January 1st, as reported here in 2018, it was 1,600,000. We have to add the adjustment for the cumulative effect on prior periods of applying the retrospective approach to the new method of accounting for construction here contract. So remember, in 2017, we used to have this retained earning of 1,600,000, but because of using the new percentage of completion, and we are assuming that this method was used in 2017, so we have to adjust for 120. So the beginning here balance of retained earnings in 2018 will be 1,720,000 as adjusted. We then need to add what? The net income that is also adjusted based on the percentage of completion method, okay? So here we got what? We got, that's the ending balance of 2018 that will be used as a beginning balance in 2018, okay? And then of course in 2018 retained earnings here, that's beginning balance, will add what? The net income based on the percentage of completion method. So we have our retained earning as of December 31, 2019, okay? So we already reflected that, of course, change in retained earnings by making the journal entry, but don't forget that when you have to prepare the retained earnings statement, you have to go back and make the appropriate adjustment for prior periods. So again, we are here presenting 2 years. So for 2018, we need first of all to adjust the beginning balance because that was based on the cost recovery. Now, if you assume that the percentage of completion was already applied in 2017, then we have to add this 120 as adjustment. So that's the new balance, beginning balance, of course, in 2018. In 2018, we have also to consider what? The net income using the percentage of completion, as if we were using the percentage of completion method. So that's the ending balance of 2018 that will serve as, of course, at the beginning balance in 2019. I will simply, of course, add the net income of the current period using the percentage of completion to have our retained earnings as of December 31, 2019, okay? Is that clear, please?
Professor?
Yes.
Shouldn't the change, because the project has been going for 3 years, shouldn't we make the change in 2017 as well?
No, because we are in 2019. We are assuming that the firm is actually presenting financial statements for comparative financial statement, of course, covering 2017 to 2019, okay? So if, for example, we are providing 2017, 2018, 2019, we would have actually provided 2017, but this in beginning balance in 2017, there is no issue, okay? So the issue will be about, of course, adjusting the ending balance of the 2017, okay? So here, of course, that's a choice. And then we just provided 2 years in this retained earnings statement. But if, for example, we choose to provide or to present 2017, it's okay, we can do it, okay? So it's up, of course, to, as we said, how much, of course, years, comparative, of course, years were presented in the financial statement, and also to the extent practicable, okay? So as a business, is it practicable for me to go, for example, for 2017, 2018, 2019? It's okay. If I choose to just provide, more often that businesses will provide for this issue of clarity, for this issue of concise information, so they will be always providing financial statement for 2018, 2019, and for 2 years, okay, for the current year and the prior year, okay? And then, of course, if you need prior periods, you'll go back, of course, to the other reports of 2018, 2017, where, for example, you'll find, of course, already this financial statement restated and adjusted based on this retrospective approach, okay? So does that mean that we didn't actually show the change or this, of course, change in accounting policy on 2017 financial statement and 2018? We already did, okay? We must do, okay? So that's, of course, how we proceed as long as it is practicable. That was what was required, of course, from, of course, the accounting standards, that you have to show the effect of your change in accounting policy on line by line, as we just stated. You see here, as we just said, for each financial statement line item effective, okay, and basic and diluted, of course, earning per share, and also for each current period and each prior period to the extent practicable, okay? So it can be 1 year prior period or more, etc. So that choice, of course, that's, of course, the custom, of course, on, as I said, for financial reports purposes, most of businesses, they are likely to provide no more than 2 prior periods, okay? So the current period and 2 prior periods for the issue of comparability, for the issue to show this historical trend in their financial statements. And of course, whenever we are providing this kind of information, of course, the adjustment, if we are providing the 2017, we would have proceeded in this way, okay? So we'll have adjusted, of course, for 2017. So we provide this line, of course, as ending, and then, of course, we provide 2018 and 19, okay? So let's see this an additional here illustration for the change in accounting policy. So now we're talking about Cherokee Construction Company that changed from the cost recovery, so still dealing with this recognition of revenues over time, to the percentage of completion method of accounting for long-term construction contract during 2019. For tax purposes, the company still using the cost recovery method and will continue using this approach in the future. You are provided with the hint that you have to adjust all tax consequences through the deferred tax liability account. And then you got this appropriate information related to the change in this accounting policy, okay? So when if you are using the percentage of completion, you got this pre-tax income that is of 780 in 2018, while you already recorded it as 610,000 because you were using the cost recovery method. So the difference is that you got what, 170,000, of course, as increase in your income, pre-tax income, if you were using the percentage of completion in 2019. For 2018, for 2019, you have a difference, of course, of 220. So if we assume that we got this tax rate of 35%, you are asked first what type of journal entries they are necessary to adjust the accounting records for changing that accounting policy, and then what will be the amount of the net income and retained earnings that will be reported in 2019, assuming that the beginning retained earning for 2018 was 100,000. Okay, so we'll just answer these 2 questions together. Okay, so first of all, please, we have to contrast both methods, okay, for the 2 here years presented, okay, for that's the current period, of course, and that's the prior period, okay. So the difference between using the percentage of completion and the cost recovery, it is 170, but of course taking off the tax effect, that's the deferred tax liability. So the net effect on income will be 110 and 500, okay. For the current year, it is 143, okay. So the journal entry will be actually as the beginning of 2019, so will be again an adjustment to the beginning balance of the retained earnings, okay. So what we do is that we will have to reflect this 110 and 140 so this is difference, the 170, that's the only for 2018. So that's the beginning, as I said, journal entry begin at the beginning of the year. Okay, so we have to consider this only 1 year here of 2018. That's the example. So here we got what? Remember again, the difference here basically that's the gross profit that we omitted or we ignored, we didn't recognize in the construction in process. Now, if we were using the percentage of completion, we would have debited the construction in process with this 170. So this is what we do now, okay, as of beginning 2019. Of course, retained earnings will be credited by 110 because this 59 will be deferred tax liability, okay? So this is the journal entry that we need because this is showing what the retrospective change and its effect actually on prior period here, one period of net income. Okay, so that's of course, if we were using the percentage of completion, my net income would have been higher of 110,500. That's why of course we have to credit now retained earnings with that amount. Okay. So let's see now comparative financial statements here for the income statement and the retained earnings. Okay, so in the previous year 2018, that's of course previously when we were using the cost recovery method. We have a pre-tax of 610, we have an income tax of 213, so my net income was 396. We got beginning retained earnings of 100. If we add the 396, that's my net income of 2000, of course, 18. I had an ending retained earning of 496. Now, if we are restating, so meaning if we are applying the percentage of completion method to that 2018 year, what will be my pre-tax? It is different, of course. It is, as it is said here, it is 780, okay? So I have 780 as pre-tax income. If I will apply the 35%, of course, I will have higher income taxes, so it is 273. So my net income will be, of course, 507, okay? That's, of course, my net income that will be added, of course, to the beginning retained earnings balance. So we got this ending retained earnings. So you see here, that's the adjustment that we already did to 2018, and then of course our retained earnings already adjusted. So for 2019, my pre-tax financial income, so now in this year we are using the percentage of completion, so that was 700. We apply the 35% of income taxes. We have our net income of 450. We got the beginning retained earnings, of course, that was prior to the adjustment. We have to adjust for the 123 and 500. That's the effect on, excuse me, of this change from the cost recovery to the percentage of completion method. So that's the same, of course. We will have, of course, use the amount directly. And then, of course, we got our net income of 455. So that's, of course, the 1,062,000 ending retained earnings, okay? Is that okay, please? So that's for the change for long-term contract here, accounting for revenues. We'll see another example here when we have to change from one of the inventory methods, okay? So if we are here considering this situation, so Lancer company has accounted for its inventory using the average cost method. So it was using the average cost method, but in 2019, the company changed it to the FIFO method because management believes this approach provides more appropriate measure of its inventory costs. So you see here, this kind of motivation or argument is not enough. So this is just for the purpose of our brief exercises. But of course, if you are really preparing financial statements and notes disclosure, you must tell more about, of course, the motivation and the reasons why. Let's say pragmatic, meaning there are more realistic reasons for this change in this accounting methods. Okay. We got also this additional information that Lancer company started its operation on January 1st. So at that time, shareholders invested 100 in the business in exchange of ordinary shares. And then we got all the other information, so sales, purchases, and operating expenses for the period between 2017 and 2019 were cash transactions, okay? So this is, of course, to simplify here the treatment, okay? So here with the cash flow over that period, it is as follow, okay? So they are all cash transactions, okay? So we have sales of 300 we have purchases of 90, we have operating expenses of 100, so the cash flow from operation was 110. The following years was 300, the same. So we're assuming here the sales were the same over the period 2017 to 2019. We had different, of course, amount regarding purchases. Operating expenses, they also remain the same. And then we got different cash flow from operations, okay? So it said also that Lancer has used the average cost method for financial reporting since its inception. So in 2017 and 2018, so they were using what the average cost method. But now in 2019, they decided to switch to the FIFO method, okay? We got also, of course, additional information that's also important because we need the inventory valuation under both the average cost and FIFO for that period, okay? So January 1st, that was the inception. That's what the beginning or the launch of that business, okay? So we got 0, of course, value of my ending inventory, okay? December 31, 2017, 10,000. If we were using the FIFO method, it will be 12,000. And so then we get, of course, this difference of 2,000. In December 31, we kept, of course, using the average method. So we got an ending inventory value of 20,000. But if we have used the FIFO method in 2018, we would have an ending inventory of 25,000. So there is a difference of 5,000. December 31, of course, we will be using the FIFO method, so we got a difference of 7,000 if compared to the average cost method, okay? We got also the cost of goods sold because, you know, when we change in the inventory valuation, it's not only the ending inventory that will be impacted by that change, okay? So we have also to consider the effect on the cost of goods sold, okay? So the cost of goods sold was 80 and 100 in 2017 and 2018. In the FIFO method, of course, it is lower here, so there is a difference of 2 and 3,000 respectively. Then in 2019, we have also 111 based on the 5, okay? It said that the earning per share is not required on the income statement, and also all the tax effect for this illustration should be ignored, okay? So assume them net of taxes, so there is no tax effect, okay? So please, to be able to apply the retrospective approach, we have, first of all, to contrast, of course, the both information for the income statement here and the retained earnings, and then what show the retrospective impact as a beginning adjustment to the beginning balance of the retained earnings, and then also go back to the financial statement and restate the present the presented, of course, years to the extent practicable, okay? So here we got the income statement for 2017 and 2018 and 2019 here, if the firm were using, of course, here the average cost, okay? So we got sales, we have the cost of goods sold based on the average cost method, we have our operating expenses and our net income. Now, if the firm actually, continuing, of course, if they were using the average cost, so the retained earnings will be 120 in 2017, then 220 into 18, and 2019, 307, okay? If the firm actually will be using still the average cost, this statement of cash flows, of course, will be cash at the end of the year, 210, 300, 375, etc. Okay. Now, if we'll be, of course, applying that retrospective here change, what we'll be doing, okay? So we will be assuming that the financial statements of this firm will be presented, but using here the FIFO method, okay? So the cash flow statements under FIFO, there is no difference, no difference, because here we talk about so the sales, the purchases, operating, etc. The cash flow here from operating activities, from financing activities, also from investing activities won't change under both methods, okay? But of course, that's obvious that the net income, they are different in each period, of course, and based, of course, on this difference in the accounting policies, okay? You know, the cost of goods sold will be different. Then, of course, the net income, it is different, okay? So let's see this kind of differences, of course, as explained, okay? So if the firm here is using the FIFO method now, the net income would have been, of course, higher of 2,000 and 3,000, etc., okay? The retained earnings will be, of course, different and higher with these 2,000 and 3,000, okay? So as we said, there is no difference in the cash flow statement. علاش على خاطر there is no tax effect to be considered, okay? In the statement of financial position, we'll have, of course, a difference regarding the inventory valuation at the end of each year here. And of course, here the retained earnings will be different, you know, under the equity section, okay? So let's see now how to apply this retrospective approach. So again, you should be able to know what are the items in the financial statement that will be impacted, okay? So under the retrospective approach, when we are changing from the average to the FIFO method, okay? So it will be what? It will be affecting the reported inventories, the cost of goods sold, our net income, and our retained earnings, okay? So we see that this difference in income, of course, of 2,000, 3,000, that's the total as of beginning of 2019 will be what? Made or shown as an adjustment to the retained earnings, of course, beginning balance in 2019, okay? So, of course, if we were using the FIFO method, our valuation of ending inventory will be higher by 5,000, okay? Because in the FIFO method, it is higher for the first year, 2017, and 2018, it's also higher by 3,000. So the aggregated here effect is that my inventories would have been higher by 5,000 if we were using the FIFO method for both, of course, years of 2017 and 2018. So that's the aggregated or cumulative effect, okay? So we debit inventory for 5,000, so we simply credit retained earnings for that 5,000. علاش على خاطر we are said to omit this tax effect, okay? So that's, of course, the journal entry that is needed. But in addition, of course, to that journal entry, we have actually to report our net income under the newly adopted FIFO for both 2018 and 2019. So if you are assuming that the firm this is the only year that they are actually, or the early one, the most recent one, year presented. So here we have to provide this comparative information for 2018 and 2019. So we have to adjust retrospectively the 2018 income statement to provide information based on the FIFO method. And of course, in the notes disclosure, again, we have to explicitly describe the nature of that change, the motivation for that change, and of course, what were these affected, of course, to the extent practicable here. And of course, we have to provide this important data on differences between amount reported and average cost versus the FIFO method, okay? So if we take a look at the retained earnings and how, of course, this retained earnings will be impacted by that adjustment, okay? So if we are providing this comparative statement for only 2018 and 2019, and of course, we must provide it, of course, under FIFO now, okay? So the beginning balance of 2018 retained earnings will be also adjusted. So what we got as a beginning balance of 2018, this is the ending balance of 2017, okay? So that's under the FIFO, the beginning balance should be 122, while we presented it in 120, of course, based on the average cost. So we have to consider 2000 as adjustment to the beginning balance. So this is what we do, okay? So in 2018, we have a beginning balance prior to adjustment as reported. It was 120. So that's a retained earnings, or that's the, we will add the adjustment for this cumulative effect. So we don't have any other prior year. We have only the 2018 here. So we'll have to adjust by 2000. So this is the adjusted retained earnings as of beginning, of course, 2018. We had to add the net income of 103. So we got the adjusted year retained earnings as of December 31, 2018. And now we got, of course, this restated retained earning as adjusted. You see here, we simply add our net income based, of course, on the FIFO method. We have our retained earnings as of December 31, 2019. Okay, is that clear, please? Is it okay?
Yes, clear,
Yes.
ma'am.
Good. So recall that you have, of course, if you are preparing financial statement, compare the financial statement, for example, in the income statement, you will be, for example, providing sales and the cost of goods sold for 2018, 2019, as if you were using the FIFO method, okay? And of course, you will be showing the effect on the gross profit and, of course, obviously on the net income using, of course, the FIFO method, okay? So this is how we apply the retrospective approach using, as I said, of course, when we change from one accounting policy to another. So please be careful. Again, what we qualify a change in accounting policy, that's change from one already applied, accepted accounting policy to another one, to another different, okay? There is no actually situation when you were not, for example, making an accounting treatment because of specific event or specific situation, and because of the new events, because of a new situation that you, as I said, like the example of not capitalizing research and development costs, then you were expensing them, then you decided to capitalize because the economic viability was proven. For that example, it is not a change in accounting policy. It is just using or applying a new accounting policy because of this new situation, okay? So that's not a change in accounting policy. And again, we are not, if, for example,